Something just hit the silver market that will decide who keeps their silver and who gets liquidated out of it. This was not a normal pullback or casual profit taking. The market did not cool off, it was pushed. In the last 24 hours, as silver ripped through the mid-$80 range and the whole paper system started to sweat, the main futures exchange reached for its biggest lever. It changed what it costs just to stay in the trade, and it did it overnight. If you were only watching the chart, you saw a spike, then a slam, and maybe you thought, all right, that was the top. But that is not what actually happened. Under the surface, one rule changed. The amount of cash you have to park just to hold a standard silver contract was raised right at the moment when small traders using borrowed money were already stretched as far as they could go. That one change forces a certain type of player to dump, whether they agree with it or not. Not because their view of silver changed, because their margin did. So if you are staring at this dip and asking, was that it? Was that the top? You are asking the wrong question. The real question is why CME hiked silver margins right, as silver was breaking out in a world already drowning in debt and inflation. Here is what that rule actually did. Silver was already in the high $80 zone, futures markets were twitchy, and CME announced that margins for gold, silver, platinum, and palladium would no longer be fixed dollar amounts. They would be set as a percentage of contract value. On paper, the explanation sounded tidy, ensuring enough collateral during volatility. In practice, it meant that as prices spiked, the minimum cash you had to post rose with them by design. And that is what decides who can stay in the game when the move gets violent. To unpack that, I want you to hold a simple 5-stage pattern in your head. Ignition, leverage, clampdown, cascade, transfer, price breaks out, and the story turns euphoric. Traders pile in with borrowed exposure. The rule change hits. Forced selling makes it look like the rally failed, and exposure quietly moves from weak hands to strong hands. By the time we are done, you will see that pattern not just in silver, but in almost every crowded trade in modern markets. So let us start with ignition. Over the last year, silver has not behaved like a sleepy industrial metal. It has behaved like a pressure valve. Prices have more than doubled from the old 20-something range, smashed through the $80 area, and as of this week are flickering close to $90 an ounce depending on which live quote you check. Gold has done its own moonshot, carving out new highs above $4,600 an ounce. Platinum has pushed up into the mid-$2,000 zone, and copper has been trading around $6 a pound after a brutal squeeze in global supply. And yet, stocks have not crashed. The S&P 500 is still hovering near the 7,000 mark. That mix of expensive metals, strong equities, and a global economy still pretending everything is fine is exactly the kind of backdrop where derivatives start to matter more than the physical market. When silver trades like this, it is no longer just coin buyers and miners at the table. You have hedge funds, trend-following funds, momentum algorithms, and every inflation hedge tourist using futures to grab a lot of exposure with relatively little cash. That is stage one. The fire is lit, and everyone is trying to stand closer to the flames. Now we move into stage two, leverage. One standard COMEX silver futures contract represents 5,000 ounces of silver at roughly $90 an ounce. That is about $450,000 of metal controlled by a single contract. You do not pay $450,000 up front. You post margin, a security deposit that says you can handle a bad move against you. Under the old fixed dollar system, the maintenance requirement on front-month silver sat in the low $30,000 range, whether silver was around 30, 50, or 80. The price could climb much faster than that number, which meant your effective leverage kept rising as the bull market ran. For large, well-capitalized traders, that was a blessing. Their upside grew faster than the cash they had tied up. For small traders, it was a slow-burning time bomb. Then comes the clampdown. CME flips the switch to percentage-based margins on the main precious metal contracts. Now the required cash moves with the contract value. With silver in the high $80 to $90 zone, a 5,000-ounce contract is worth around $450,000, and a 9% margin works out to something in the low 40,000s per contract. Nothing about the metal changed, but the cash you must post jumps. If you're a small speculator who built a position when silver was in the 50s and 60s, you size that bet around the old dollar-based regime. You rode the run-up, then overnight the methodology changes, your leverage is dragged back down to earth, and the same stack of contracts suddenly demands far more cash than you planned for. Your thesis did not change. The rules did. This is where the mechanics get brutal. Futures are not like stacking coins in a safe. You do not get to sit through the drawdown if your margin is missing. If your account balance falls below the maintenance level under the new rules, your broker does not ask whether you still believe in silver. They ask one question: can you wire more cash today? If the answer is no, your position is cut. Now scale that across thousands of accounts. Silver spikes, the new margin formula ratchets, required cash higher because contract values have exploded. and a whole slice of smaller and mid-tier traders discover they are suddenly underfunded. Liquidations hit almost at the same time. That is the cascade. The price does not drift lower. It can fall in sharp, ugly candles. On the chart, it looks like the breakout failed. In the headlines, it will be sold as profit-taking or volatility cooling off. Underneath, something very different is happening. The exchange has manufactured selling by raising the cost of staying long at the worst possible moment for traders who are using a lot of leverage. It is not illegal, and it is technically transparent because the notices are public, but it is not neutral. Raising margins when a market is crowded on the long side will always hit longs hardest. The players best equipped to meet those new cash calls, the banks, large funds, and market makers, are the ones who can then step in and buy into the forced dip. That is how what looks like a failed rally can quietly become a transfer of exposure from weak hands to strong hands instead of a real collapse in demand. We have seen this movie before. Go back to 1980 and the Hunt brothers. They tried to corner silver, buying so much metal and so many futures that they controlled a huge chunk of the non-government supply. Prices went from single digits to almost $50 an ounce. The exchange did not just stand back and watch. It changed the rules. It tightened leverage, raised margins, pushed trading into liquidation only, and it did it right when the hunts were most exposed. When they could not meet the cash calls, the structure snapped and silver crashed. Fast forward to 2011. Silver explodes higher again, this time in a modern ETF-driven bull run. As futures push into the high $40 area, CME raises margin on the main contract again and again in a matter of days, roughly doubling the cost of holding a long position with borrowed money. Silver is not banned, it is just suddenly much more expensive to stay in the trade. Prices drop by almost a third in a few weeks, and a lot of latecomers decide silver is too dangerous and walk away for years. The stories are different, but the spine is the same. A rapid move up, crowded positions, fast tightening of margin, then forced selling. What you are living through now is not a strange one off in 2026. It is the latest chapter in a long habit of exchanges, using margin policy as a steering wheel. Once you see that, a sudden rule change no longer looks like neutral risk management. It looks like the strongest legal price lever they have. So what is really changing when CME pulls that lever? Not in the chart, in the real world. Did new silver mines open last night? Did factories slash their orders for metal for electronics, solar panels, and data centers? Did mints and dealers wake up buried under unwanted inventory? No. Silver is still flowing into panels, cars, and circuit boards. Platinum is still needed for industrial catalysts and high-end manufacturing. Copper is still trading near record levels because the grid and electrification push has not gone away. The paper market has changed. The physical world has not. That is the gap most new investors miss. A margin-driven dump is not the same thing as a demand-driven bear market. One is plumbing, the other is fundamentals. In a margin event, the weakest holders, those who are stretched and using a lot of borrowed money, are forced to sell. The strongest holders, those with cash and patience and often existing shorts from higher levels, get to decide whether to buy back, flip their position, or simply reduce risk. Control over claims. On silver moves from fragile hands to stronger ones, the amount of metal in the ground does not change by a single ounce. Critics of this system argue that percentage-based margins at moments like this are less about protecting the market and more about making sure price surges do not get away from the institutions that are structurally short volatility in metals. You do not have to sign up fully to that view, but you do need to understand the machinery before you let a few red candles rewrite your conviction. And if you think this kind of intervention belongs only to silver, it does not. Look at nickel in March 2022. Prices on the London Exchange did not just rise, they almost quadrupled in 3 days. Clearing members were hit with huge margin calls. At one point, regulators warned that more than a quarter of those members could fail if the move kept going. Faced with that cliff, the exchange did more than raise margins. It halted trading and canceled an entire day of nickel trades after prices blew through $100,000 a ton. That decision shielded some large, short players from disaster, but wiped out the gains of traders who had sold at those high prices in good faith. Years later, there were fines and court cases, but the simple lesson for you is that when the survival of the venue is on the line, the rulebook is not sacred. Nickel is a different metal on a different exchange, but the logic is the same. Once prices move far enough and the wrong people are trapped on the wrong side, the priority shifts from what is the fair price to what keeps the system standing on Monday morning. Margin changes, trading halts, even canceled trades are all tools from the same drawer. They do not create an extra ton of nickel or an extra ounce of silver. They decide who survives the move and who is forced through the exit. That is why it is dangerous to treat futures markets as neutral. Scoreboards. They are arenas with referees who hold emergency powers, and every time those powers are used, you get one more clue about whose safety really comes first. Now let us bring this down to you. There are roughly 3 kinds of people watching silver right now. First, the physical stackers, the people with coins, bars, maybe some metal sitting in allocated storage. Second, the traders in futures and options, renting exposure with borrowed money. Third, the curious outsiders staring at the price on a phone and wondering if they already missed the move. If you are in the first group, the margin change cannot reach into your safe and take your coins. Your metal does not care what CME decides. What does react is your head, because the number on your screen is being set in the same arena where the rules just shifted. The trap is letting a policy tweak in Chicago rewrite your confidence in your own balance sheet. If you are in the second group, you already know the deal. Futures are a place to trade, not a place to park family wealth for decades. You are renting risk in a venue where the people who run it can change the terms while you are still on the field. If you are in the third group, this is the fork in the road. You can wait for clean confirmation signals from a market that is willing to change the margin rules in real time, or you can pay more attention to the gap between paper price and real-world tightness, the premiums, the delays, and the differences between markets overseas before you decide what to do. None of this is financial advice, but understanding the structure is no longer optional. Now zoom out a step. We are not living through a tidy interest rate cycle. We are in a world where public debt runs into the tens of trillions, where interest costs are starting to compete with defense and healthcare, and where central banks that once promised to crush inflation are under pressure to live with it, because keeping real yields below inflation makes yesterday's debt easier to carry. In that kind of world, hard assets are not a curiosity, they are an irritation. Gold above 4,600 and silver near 90 are not just numbers for collectors. They are a public scoreboard that says the currency is losing buying power faster than leaders want to admit. Silver is even more awkward because it is not only a store of wealth, it sits inside industrial supply chains from solar cells and electric vehicles to data centers and high-end electronics. When investment demand and industrial demand collide in the same metal, the result is not just a price spike, it is strain in the supply chain. That is why this shift to percentage-based margins at this moment matters. It does not conjure up fresh mine output, and it does not change how many solar panels governments want to roll out. It mainly makes it harder for marginal speculators to sit in long positions when silver is acting exactly as you would expect in a world of negative real yields and financial warfare through currencies. From the big picture point of view, this is one more version of a pattern we have seen after past debt blowouts. Debts reach levels that cannot be honestly paid. Inflation and quiet financial repression do the work in the background. Hard assets shout the truth, and the system tries to muffle that shout with rule changes. So what do you watch now that CME has pulled this lever? Do not live and die on every cent of price action. Watch the points where the paper market and the physical market touch. Do overseas and spot markets keep trading silver at a premium to the main United States quote? Do dealer premiums on coins and bars collapse, or do they stay stubborn even if the futures price dips? Do delivery requests and vault reports show metal drifting out of registered storage or being stacked back in? Do we see another round of margin adjustments if silver fights back toward the highs? Those are the signals. If drops that are driven by margin stress keep getting bought, and if spreads and premiums stay elevated, that suggests this was not a final peak. It was the later stages of the pattern playing out in front of you. If instead physical demand fades, premiums disappear, and inventories grow, that is a sign the move was ahead of itself and that the macro buying pressure is easing for now. Either way, you're not stuck. You just need to pay more attention to the machinery underneath the price than to the headline number itself. One more thing people do not like to talk about. Events like this are not just a test of your balance sheet, they are a test of your discipline. A notice goes out after the close, the new margin rules bite the next morning, and your social feed fills up with red candles and panic. That panic is not an accident. It is part of how the system works, because discouraged and confused investors are easier to steer. Easier to push back into savings products that do not keep up with inflation. Easier to push back into broad index funds that depend on the very system they were trying to hedge. Easier to push back into trusting that the people in charge of the rules will always play fair. But cycles in hard assets rarely reward people who only feel brave when everything is calm. If you truly believe the real market, the coins, the bars, the ounces locked into solar farms and circuit boards, matters more than the paper casino, then you have to behave that way when the casino rewrites the rules. That does not mean going all in. It means size your positions for real volatility, use money you can leave alone, and pay more attention to premiums and availability than to the drama of a single day. So how do you stay sane the next time an exchange changes the terms on you? Give yourself a simple 3. Give. Question playbook. First, is this change adding stress at the peak or quietly smoothing it in normal times? If margins are tightened into a vertical move when everyone is on the same side of the boat, that is not routine housekeeping. that is the move itself. Second, what is the physical market actually saying? When the futures price drops, do premiums and wait times for real metal ease, or do they stay tight? If paper falls but real-world supply is still strained, you are likely looking at plumbing, not a collapse in demand. Third, who gets relief from this timing? Does the change ease the pain on big short players or on funds that went too far out on margin? And does it arrive just after record prices or right before key expiry dates? You do not need a doctorate to run that checklist. You just need to pause long enough to ask it before you let one ugly candle wipe out an entire thesis. Let me finish with 2 questions I genuinely want you to answer. When an exchange shifts from fixed dollar margins to a percentage of contract value, right as a market is breaking out, do you see that as careful risk management or as targeted damage control? Why? And if we see another sharp drop that is clearly driven by margin mechanics rather than by real demand for metal drying up, are you personally more likely to be a buyer, a holder, or someone who steps aside? By now, you know the pattern, the ignition, the rush of leverage, the clampdown, the cascade, and the quiet transfer into stronger hands. Most people will only ever see the candles and the headlines. You have seen the wiring behind the wall. If you want to be early to the next rule change, instead of reading about it after the fact, subscribe so you do not miss the next breakdown when metals, currencies, or debt markets do something that is supposed to be impossible. And if you know one person who still thinks these markets are always fair, share this with them, not to scare them, but to show them how the lever is really pulled. Because the main story here is not that silver dipped. The main story is why it had to be pushed. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.